If you want to retire early, you have to know what you need to be financially independent. The answer: 25 times your annual expenses, or more precisely, 25 times your annual expenses in retirement. But let me show you how we got there.
I'm the fireman, and I'm trying to reach financial independence before I turn 30 years old. But to achieve that objective, I have to know what I'm actually shooting for.
This is an extremely important question. After all, retiring prematurely might mean you run out of money. And even worse, you'd be running out of money after you've been out of the workforce for a long time. So going back to work at that point would really suck.
But overshooting your target comes with a cost too. If you work longer than you need to, that's potentially years of your life wasted. That's not ideal either. So we'd like to know as best we can how much you need to have saved to safely call yourself financially independent.
Now, if you've ever looked into this question before, you might have found all kinds of absurd rules of thumb and weird colloquial advice. But these have two big problems. One, they aren't informed by data or reality. And second, they're not designed for people like you and me that are trying to reach financial independence at a much younger age. So we can throw a lot of that advice right in the trash.
First off, it goes without saying that what you need to retire depends on your expenses. The definition of a successful retirement is to be able to afford your expenses for every year that you're retired.
That means that there are really just two numbers that determine how much you need to be financially independent. First is how much you spend every year, because you need to withdraw that from your nest egg every year to support your expenses. The other number that matters is what money is worth, or the average investment return. And that's because without investing, there is no such thing as financial independence. Your money would just run out eventually. For example, I've already claimed that you need 25 times your annual expenses to be financially independent. So if you spend $40,000 every year, you need around $1 million to retire. But if that money is just sitting in the bank, then that $1 million is going to be $0 in 25 years.
In fact, it's actually worse than that. And that's because inflation is typically a few percentage points. And year over year, that's usually not a huge deal, but over time, that can really add up. And that means that if inflation just averages 3% per year, that $40,000 you spend will also probably have to adjust by 3% per year to keep that same quality of life.
That's bad news for your $1 million in the bank because that means it'll run out after 19 years. Not exactly a long lasting retirement, especially for people that are trying to retire early.
I even did a little math to see how much you would need if you didn't invest. See, to spend $40,000 a year for a 50-year retirement, which would be maybe retiring at 40 and passing at 90, then you would need $2 million. But once you factor in a 3% inflation rate, you would actually need $6.77 million. And if you have that kind of money for a 50-year retirement, I want to be watching your YouTube videos.
Moral of the story: if your money isn't growing, you're going to have a really tough time retiring.
But the good news is that money can make money. Not only can money make money, it should make money. And that's because money can buy assets that cause economic growth. So by investing, you should be worth more money later. In fact, companies will actually just pay you for your money. That's what a bond is. You give the company your money, they pay you interest payments on it, and then at the end of the bond life cycle, they just give you all of your money back. Banks do the same thing with loans, but a slightly different structure. They are loaning or selling money.
So, how much is money worth? Once we know that, and once you know what you spend every year, you can calculate how much you need to retire.
That's because once your wealth multiplied by the rate of return on money equals your annual expenses, you're financially independent. Your wealth can create enough money every year for you to live off of for the rest of your life.
Now, there are a ton of ways to invest, and which particular strategy is best depends on a lot of different things. Each of those different investment strategies will have a different average rate of return. But the way most people invest is in large index funds in the stock market, so I'll talk about those.
The good news about the stock market is that there's a lot of publicly available information on it. The S&P 500, which is about 500 of the largest American companies, is one of the most well-studied indices. I looked it up, and in January of 1913, if you would put $1,000 into the S&P 500, right now you would have $1.4 million.
Oh, and what about inflation? After all, we saw how big of an impact that could have over a long period of time. Well, guess what? That's already accounting for inflation. In other words, that would be $1,000 of today's money invested in 1913, which, adjusted back to that time period, would be a lot less dollars. By the way, if you actually invested $1,000 in 1913, you'd have $38 million, not $1.4 million. So yeah, inflation does make a really big difference over a long period of time.
And look, you probably won't be investing over a 100-year time frame. But you also don't need to turn $1,000 into $1 million. But what those numbers tell us is that the S&P 500, adjusted for inflation, has had an average return of just over 7% over that 100-year period.
All right, so how much you need to retire depends on how much you spend and how much your money goes up. So once 7% of your net worth equals your expenses, you can retire, right?
Well, no. If your money returns 7% every year, you would need just over 14 times your annual expenses to be financially independent. You wouldn't even need $600,000 to retire on that $40,000 per year lifestyle. But it's not that simple. And that's because while 7% is indeed the annual average, the variability year by year is a lot.
Take a look at this graph I threw together. This is the annual return of the S&P 500. There are a lot more points above 0% than beneath, but if there is one thing that should stick out, it is that the annual returns are anything but consistent.
Naively withdrawing 7% would put you at a lot of risk of running out of money. You'd have to get kind of lucky. So, how do we know what a safe withdrawal rate actually is? Well, that's what the Trinity study wanted to find out.
The Trinity study was a famous study conducted in the 90s to see what would happen to an investment portfolio that was invested in government bonds and the S&P 500.
They used decades of historical data to see what would happen to a retirement over 30 years, depending on two different factors. One, what the withdrawal rate was, and second, how much of that money was invested in stocks versus bonds.
This simulation is actually somewhat simple. Using publicly available inflation numbers, you can just adjust the annual expenses by that number to see what somebody would have needed to spend. And using the publicly available investment information, you can see how the portfolio would have adjusted with that money withdrawn. If the money ever runs out, the retirement didn't work. If there's anything left over, it was a success. For example, if the simulation began assuming somebody had $1 million in assets and spent $60,000 every year, that would be a 6% withdrawal rate. And by adjusting that $60,000 for inflation and adjusting that $1 million for historical stock prices, then you could start to see whether that person would have run out of money or not. If you do this for lots of different scenarios and every year on record, you start to get an idea of how big your retirement nest egg would need to be. And even better, great work over at thepoorswiss.com has actually updated the Trinity study for more recent years and also considers retirements of 40 and 50 years instead of just the original 30 years. What the Trinity study found was that in 95% of the 30-year timeframes they looked at, a 4% withdrawal rate is safe, and that corresponds to 25 times your annual expenses in invested assets. And this 4% rule of thumb is what the Trinity study is most famous for. There are three big takeaways from the Trinity study, which are pretty intuitive. First, a lower withdrawal rate is always safer. If you retired with $5 million and spent $50,000 a year, that would be a 1% withdrawal rate, and it would be extremely unlikely you would run out of money. In fact, a 1% withdrawal rate has never run out of money in the past. That's always worked. Second, the shorter your retirement, the less you need to retire. For example, if you'll only be retired for 15 years, then you can probably withdraw more than 4% and not run out of money. But if you'll be retired for more than 30 years, like many people in the FIRE community would be, then it's probably safer to withdraw less than 4%. Third, a high allocation of stocks as compared to bonds probably means you need less to retire. That's because stocks go up with inflation, whereas bonds don't. Plus, stocks just generally have a higher return than bonds. That doesn't mean you should put all of your eggs in one basket and invest only in stocks. If stock prices plummet right after you retire, that could be a huge drop in your nest egg, and bonds would actually really help out. So it's not a bad idea to have some of your investments in bonds as well. So let's quickly review. For an investment portfolio of primarily the S&P 500 along with some government bonds, a 4% withdrawal rate was safe in 95% of the 30-year retirements. For a retirement longer than 30 years, something a little less, like 3.5%, maybe 3.75%, is a safer idea. Now, two caveats. One, this assumes that your expenses will only increase with inflation. And second, and this is an important disclaimer, this is only based on historical data. I have no idea what the stock market will do in the future. If it keeps doing what it's been doing for the past 100 years, I'm probably in good shape to be financially independent at 30. But there are no guarantees. The 4% rule might not hold in the future. No one knows for sure. When you pull the trigger on retirement will be up to your own risk tolerance. All I can tell you is the data. And to actually get 25 times your expenses in your savings, you need to set good financial goals. And to see how to do that, you need to watch this video. Thanks so much. See you next time.